The real estate market is very diverse, very widespread, and very volatile. 30 years ago, I couldn't say this about housing, but today, everything is upside down. This is all due to insane central bank policies which have caused all markets to be ruined until order can be restored. Do you think that the Fed will be able to normalize their monetary policy? You came here for the truth, so let me unveil that for you. Today we're going to look at real estate. I found several charts from this site here. I want to show these to you. I think they are extremely important, very relevant, and very timely. Let's begin by taking a look at pending home sales and 30-year fixed mortgage rates. What I want to show you here in the blue line is the pending home sales index. And you could see that it has actually topped off and begun to decline. This, to me, spells disaster. When we look at what has been occurring here with all of the different mortgage rates, interest rates, and everything over the last little while, clearly we've seen this uptick. Since basically this time, you can see right here in this chart, in fact, right about here in the chart, which is the end of 2015, that's when they started to bring up the interest rates, okay, just a little bit. And it's since that point that was basically the peak, according to this, of the pending home sales index. Interesting correlation, perhaps not entirely related, but it is a correlation. You're looking at the red line as well, which is basically the 30-year mortgage rate, and it's on the inverse, of course. And what you can see is that these trend together. As we see these rates going higher, we're going to see home sales declining. And that is a simple matter of fact. It is going to get very messy when we start to see much higher rates. I mean, they're still historically pretty low, so we'll see what happens. Mortgage applications, market index, and 30-year fixed mortgage rate. So again, the red line is the 30-year mortgage rate, and the blue is the weekly mortgage applications in the market index, and that has been declining significantly in a percentage change year over year. What you need to worry about is not what happens today or last week or last month. You need to check out the trend. I think that is absolutely critical, and you can see where it has gone since here 2016, essentially, where we saw that really taking effect. Private residential construction spreading and 30-year fixed mortgage rate. Again, similar information showing that on this chart here. There is no doubt in my mind that the mortgage rates increasing are having a negative impact on the housing prices as well as just sales in general. Now, am I saying that the prices have declined significantly over the past few years? Absolutely not. But you need to address this on a more micro level. So we'll get into more of that in a moment here. New home inventories are rising. This is really the worst possible thing for real estate. You want the inventories to remain low, and that keeps prices high. But as you can see here, this has been an issue for all of these homes increasing. Why? Because construction is continuously going on. Look at any skyline in any major city and you see cranes as far as the eye can see. In Toronto, we have subdivisions that are built. You know, a lot of people do buy into these subdivisions, but they're built up entire subdivisions. I'm talking hundreds, perhaps thousands of homes in some cases. Before anything happens, they already know, don't worry, we're going to sell out. Perhaps that is the case, but we don't know that. And eventually, this is going to happen where you have a subdivision built and nobody's buying. And we saw similar activities happening during the last housing crisis going on in Las Vegas, outside of Las Vegas, for example, where you would have all of these subdivisions, but there's no buyers. And we had, I believe at the peak, 19 million empty homes. Today, there's still in the US many empty homes. However, those numbers I think are very skewed because they can show that the home is occupied when really it isn't. Okay, they're making it seem as if it is occupied. So they can do that and play some tricks, make things seem better than they really are. Now we're looking at the S&P Case-Shiller Housing Index, a very important index for housing, and you'll see that here has been drastically inclining over the past several years. Since the financial crisis, things were sort of weary for a little while, but it didn't take too long before housing, before the stock market, and all of order was apparently restored. And so we can see that here. This is the 20 home price index, as well as Denver, Dallas, Miami, and Las Vegas. They're all increasing at different rates, surely. You can see Las Vegas, that has been skyrocketing. Seattle's been skyrocketing, and other places around the United States. NAR Housing Affordability Index. And to me, this is really what it comes down to. Yes, the prices can increase. We can see that. Look at the Case-Shiller Index. Obviously, prices have increased. But when you look at the affordability, you start to be really realizing what the truth is. Yes, your home can increase. Yes, people can benefit by that increase simply by taking out a home equity line of credit, simply by using their home as an ATM. But it is disastrous at a certain point in the future. Look at what happened during the housing crisis, where people were completely underwater. They had to leave the home. Some people had to go bankrupt. This is going to eventually become a problem because a lot of these people are taking out all the equity in that home, and as long as housing prices rise, the scheme can continue, but it doesn't last forever. And a lot of people are, unfortunately, they are fooling themselves. Okay, I'm trying to be as polite as possible. This, by the way, just in case you couldn't see it, but the blue line basically is that affordability index, which ever since prices have been rising, affordability has been going down. And it's at a bad level today, where we can see that we're moving back into the territory of the whole subprime crisis and everything else. I worry about this because a lot of people are harmed by it. They're getting into the homes and they can afford it today, but mortgage rates are rising. And that is a problem because people cannot pay their bills if they keep rising. Yes, they can do so for the little while. If mortgage rates are 4.72 today, maybe they're 5 tomorrow. Maybe 6 months, maybe a year from now, they're 6.5%. And eventually that breaks people's backs because you've got this issue that people think that they can do more than they really can. And that, to me, is truly worrisome because it affects everything else in line with it. A lot of people think that, I don't need to worry because I'm paying my mortgage, or I don't need to worry because I can afford it, I have a lot more money, or I don't need to worry because I'm not even in that country or in that state or in that province or in that city. But eventually it makes its way back around. Well, I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support the channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, these two books have it all. You can actually check these out at the link in the description. I talk about everything from the foundational principles, I get into the asset classes, all of them. I break them all down, teach you so much about that. There's a chapter about each asset class, and that's the Money GPS. And then the global economic collapse gets into the subjects, sort of fills in the blanks for the topics I could not get into in the Money GPS, but also covers familiar information as well. So check them out. Link is in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com. One of the most common questions I get every single day is, What do I need to pay attention to be able to know when the global economic collapse is coming my way? Number one, it's a slow and steady decay. It's already happening. It's been happening for a while. 2008 was the first part, and you will find that there are certain stages that go along with this. We'll enter the next stage at some point in the future, but the most important factor is interest rates. That's set by the central banks, most importantly the Federal Reserve, but you also need to look at all the other central banks and understand what they're doing at all times. Anytime a central bank does anything in terms of interest rates, in terms of quantitative easing type measures, you need to pay attention. They all talk to each other, they all work together in concert. So that's it. Pay attention to that, and that is the number one. You need to look at hundreds and hundreds and hundreds of indicators, but the interest rates, their monetary policies are absolutely critical.